Welcome to the podcast from Morningstar UK, the leading provider of investment news, views and analysis. This week, we discuss the Chancellor's spring statement, tips to legally reduce your tax bill in preparation for the end of the tax year, Trump's trade tariff and more. A few hours ahead of Philip Hammond's spring statement, Emma Wall, senior international editor for Morningstar, spoke with Keith Wade, chief economist at Schroders, to discuss their outlook for the UK economy.
Hello, Keith.
Hi.
So we're speaking a few hours ahead of the Chancellor's first spring statement. Now, it is expected to be a bit of a non-event. But one of the things that we have had a leak on is that Philip Hammond is expected to upgrade growth for 2017. What is he expected to move the figures to? What have been the main tailwinds for economic growth in the UK?
So it looks as though growth for 2017 is going to come in at about 1.7%. So that's a bit better than what was expected back in the autumn when they were looking at around about 1.5%. And a couple of things have helped that. We've had a slightly better trade performance. We've actually had a little bit better productivity performance as well. So those factors have helped, and of course the consumer has kept spending as well. So that's just lifted growth a little bit more than was expected a few months ago.
And if we were talking 18 months ago, when Brexit was exploding, yes, significantly better than a lot predicted, because we were supposed to be in recession by now, weren't we?
Well, there were a lot of forecasts of recession. I think economists were a bit too pessimistic at that time, and I think we would probably say that we were also in that camp. I guess what surprised people was that consumers kept spending. People actually borrowed a little bit more and kept the credit going and kept going. But one area that has been weak and pretty much has expected after the Brexit result was corporate investment, which has been very flat. And that has been disappointing because we are in an environment now where globally investment is very strong. So we're seeing strong investment in the US, Japan and in Germany as well. But the UK is not sharing in that, and I think that's something he might want to look at.
So if you were to write a wish list for the spring statement, would sort of PLC's supportive policy be in there, given what you've just said?
Well, I think so. I mean, of course, one of the main reasons why investment is weak is because of the uncertainty over Brexit. And so in many ways, what most of UK PLC wants is to get some clarity and get on with the Brexit talks and get a trade deal, get a transition period, and then people can plan for the future. So that's very important. But it might be, if he wants to do anything, that he might try and direct something towards maybe improving the environment for investment, maybe some allowances or something like that to encourage investment in the UK.
And what about what this recent uptick in growth means for the Bank of England and for interest rate rises? Because if we are in a slightly more robust economic environment than was expected, does that mean we should see a rate rise this month or indeed for the rest of the year?
Well, I mean, the market is just about pricing in a rate rise for May. We still think that's a little bit early, because again, I think you don't want to damage confidence at this very early stage. And we know that we're getting into the difficult part of the Brexit negotiations on the trade. So if they were to raise rates and it was a difficult time and there was some adverse comment coming from Brussels or what have you, I think that could be quite damaging. The Bank of England is working on the basis of a smooth Brexit. It seems to us that there won't be real clarity on that until much later on in the year. So we still think that November is probably the most likely point at which interest rates begin to rise.
Keith, thank you very much.
Thank you.
Chancellor Philip Hammond has delivered his inaugural spring statement, with much of his speech a confirmation of policies announced in the autumn budget. Emma Wall gives us an overview next.
UK Chancellor Philip Hammond has just delivered his inaugural spring statement, having moved the budget to the autumn last year. As expected, it was a bit of a non-event. He wasn't expected to release any big policy changes, and all he really did was confirm the policies and the proposals that he set out in the autumn budget 2018. These included confirming how many people had taken advantage of the stamp duty new allowances, and indeed how many houses had been built and the progress that had been made on infrastructure projects. What was new news was the upgrade for growth in 2017 from 1.5% to 1.7%, although this was leaked ahead of the event. He made some predictions about where we can expect inflation to go from here, coming down from 3% it is today over the next 12 months to the government's target of 2%. He said because of this, we could expect real wage growth, which we haven't had for some time. The only new news? Well, there will be some consultations around environmental issues, including helping white vans get more green, and indeed some other things such as helping plastics and the impact that they have, the detrimental impact that they have on our oceans. All in all, bit of a non-event, but positive news on the policies from the budget 2018.
Will interest rates rise this month? Emma Ward talks to JP Morgan's Mike Bell about the outlook for US jobs and how that could impact interest rates on both sides of the pond.
Hi, Mike.
Hi.
So on Friday, we should expect to have US employment figures. Probably not a data point that the average UK investor has really given too much thought to until recently, because it was employment figures in the US which was one of the main causes of the global market sell-off last month, wasn't it?
To be honest, it's always been one of the most closely watched figures in markets, if not by the common man on the street. And what everyone was focused on last month was the fact that the wage growth numbers picked up to 2.9%. Now, what everyone's going to be very focused on this month is to see whether that number comes down slightly, because there was an adjustment in the numbers because of the bad weather that's been affecting America. The number of hours worked, we think, fell. And as a result, that boosted the average hourly earnings slightly higher than it would be. So consensus forecast is that that number falls to 2.8%, slightly down from last month. Were that to not be the case, and actually you saw average hourly earnings picking up further, I think that would cause markets to take the view that actually the Federal Reserve was even more likely to be putting the foot on the brake.
And this is the thing with markets, it's expectation versus reality, isn't it, which causes this volatility. And you're saying if the consensus view proves right, we shouldn't expect too much movement. However, if it's a surprise on the upside, then we could be in for another bout of volatility.
Yeah, I think the risk for markets at the moment is definitely a concern around building inflationary pressure. So if consensus is correct and wage growth just stabilises at around the 2.8% level, then markets should be fine with that. But were we to see a number showing wage growth coming in at, say, north of 3% year on year, I think there would be another bout of market volatility as people start to price in the fact that the Fed would therefore be more likely to tighten monetary policy at a faster pace than otherwise. Now, already we're of the view that the Federal Reserve is going to put interest rates up 4 times this year. But if you start to see signs of building inflation pressure, then markets could get concerned that actually they end up having to do more than that.
And we don't have to wait too long to hear what the Fed's going to do about interest rates. I think they're meeting on the 21st of this month. Should we expect, given the view of 4 raises this year, that to be a date where we do see US interest rates rise?
I think the Fed are probably going to raise interest rates every quarter, so we'll see one coming up in March, and then we'll get another rate rise around the middle of the year. And I think they'll just go every quarter, probably until it ends up over tightening, and eventually perhaps sometime in late 2019 or even in 2020 causing the US economy to slow, because the unemployment rate's probably going to keep falling. So we're in a world now where we could see US unemployment fall from already very low levels to somewhere around 3.5% by the end of the year.
But again, these are things that are expected by the market. So if the Fed does raise rates in a couple of weeks, we shouldn't expect too much impact on markets.
So at the moment, the market's now moved. If you think back to September of last year, the market was expecting very little in terms of rate rises this year. It's now moved to price in pretty much 3 rate rises. As I say, we think 4 is the most likely outcome, and there's only about a 25% probability of that currently being priced in. So it suggests that there's a little bit further to go in market pricing, but most of that is already in expectations, as long as we don't get significant upside surprises on the wage data.
And the Fed is not the only central bank meeting that week. The next day we should expect to hear from the Bank of England. Do you think they will also be raising rates that week?
I think that's unlikely. I think the key thing for the Bank of England is going to be whether we get a transitional deal. If a transitional deal can be agreed before May, then I think the Bank of England want to be putting interest rates up in May, and possibly, if we get the transitional deal by then even again in November. Without a transitional deal and all the political uncertainty that would come with that, risks of a hard Brexit, I think that would cause the Bank of England, or at least it should cause the Bank of England, to delay with their rate hiking path.
Mike, thank you very much.
Thank you.
Why are US job figures a data point for economists across the world? With employment figures out from the US this month, Rathbone's Ed Smith discusses how US employment data can determine whether bonds or equities will outperform.
Hi, Ed.
Hello, Emma.
So we've had some employment figures out from the US on Friday, but before we go into the details of those particular ones, I thought you could explain why US jobs figures are a data point that economists across the world pay attention to.
Well, first of all, it's an incredibly rich data release. We have tens of thousands of lines of data released in that jobs report. And of course, the US is still very much the barometer of the Western world economy. Yeah, it counts for the lion's share of the G7 GDP data, and of course almost 50% of the MSCI World Equity Index, so investors are interested too. Now, the level of unemployment in the US is a really important indicator for where we are in the business cycle. And of course, equities behave very differently at different stages of the business cycle. And I'm an asset allocator, so my first point of interest is whether I should be in equities or bonds. And the performance of equities relative to bonds is the mirror image of something we call the unemployment gap. So what the level of unemployment is relative to trend unemployment, a slow-moving average. If unemployment is accelerating sort of away from the trend, or is getting lower and lower, but further below the trend, we say that the unemployment gap is rising, and that means that equity markets are going to outperform bonds. And that, if you see that relationship on a chart, it really is an incredible mirror image. So it's really important. But the data we get with the jobs release is full of coincident indicators. It tells us what the economy is doing right now. And of course, to get a jump on equity markets, which tend to be forward-looking, you need to look at some of the leading economic indicators, and they're not necessarily in that report.
Having said all that, the most recent jobs figures that came out on Friday, what trends can you see in that set of data?
Well, it was a really strong release. We had an extra 313,000 jobs. Only 205,000 jobs were expected to be added in February. The previous 2 months, job creation was also revised up by about 54,000. So that's great news. It means we're getting the health of the labour market is continuing to improve. That unemployment rate doesn't look as though it's going to start to tick up, start to close that gap when bonds might start to outperform equities. It was really encouraging. There was a broad base of jobs creation against different sectors, but there were some interesting points as well. Manufacturing added a lot of jobs, and construction did as well. And those two things are very close to Trump's heart. And actually, his policies could mean that manufacturing companies and construction companies may be in for a bit of cost pressure because they're adding all these jobs. But if he starts to curtail immigration a lot more, that means far fewer people for construction companies to employ, particularly as some of them are known to employ illegal immigrants. And manufacturing jobs are also increasing because of global trade. But of course, Trump wants to limit the US's involvement in global trade, and that might have some effects there too. So there's lots of interesting stuff to think about.
Now, the previous jobs figures caused a bit of a global stock market upset because they were much better than expected in terms of wage inflation, which caused inflation concerns, which led people to say that the Fed would hike rates more than 3-4 times this year, and so markets got spooked. In regards to the most recent figures out just on Friday, what can we conclude the Fed might do based on that more recent data?
Well, I think there were sighs of relief echoing across trading floors all around the world on Friday afternoon, because the headline rate of wage inflation fell back to 2.6%. It was originally estimated at 2.9%. That's the annual rate of change. And that's when the markets got spooked. We had that big correction. That was revised down actually a little bit to just 2.8%, and the next set of numbers was just 2.6%. So big sigh of relief, and that perhaps might mean that the Fed doesn't have quite so much impetus to increase rates by more than 3 or 4 times this year, which of course was what markets were worried about. I think we first of all, we do question that the theory that strong wage growth necessarily means the Fed is going to hike. Wage growth, even at 2.9%, that's still reasonably low by historical standards. We don't buy into this idea of that there's this big hockey stick moment in the Phillips curve, that relationship between unemployment and wages. When unemployment gets so low, suddenly wage growth goes right through the roof. We don't see that when we do the historical analysis. And thirdly, there's very little correlation between wages and inflation these days anyway. And the Fed's interested in price inflation, not necessarily wage inflation. And if there's not much correlation, then perhaps we overstate the importance of the wage numbers in the payrolls report.
Ed, thank you very much.
Thank you.
Up next, Morningstar Investment Management's Dan Kemp speaks to Emma Wall about rising US bond yields and where he sees value for investors.
Hi, Dan.
Hello, Emma.
So, good news for income investors. US bond yields have risen, haven't they?
They have, and I think that's exactly the way to think about it. So often when we see bond yields rising, it's because prices are falling and people worry about the overall value of their capital. But that's very much a backward-looking view. From a forward-looking perspective, then yes, rising bond yields means more income for people and also a better overall total return. So we've been quite negative about bonds, as you know, for the last couple of years, and we've really stayed away from bonds as far as we can. But now, for the first time in a little while, bonds are starting to look more attractive, but not all bonds, specifically US Treasuries.
And this is good news, not only because it is another place to look for income, but that means diversification. What about at what price? Because I know that you guys are all about valuation and diversification. So the valuation element, what does that look like?
Well, that's right, and it's really the valuation that's driving us to look a little bit more at US Treasuries. As you know, the newspapers and websites are full of concerns about US inflation, and that may be why prices have been moving. It's certainly why the commentators think prices are moving. But really, when we see prices like that, when we see bad news, when we see concerns about inflation, that's normally the time to take a sober look at valuations. And from a valuation perspective, US Treasury bonds are now looking attractive. The challenge for UK-based investors is that if you're buying US Treasuries, typically you're buying the US dollar, and that's not so attractive. And so in our portfolios, we're looking for hedged share classes to avoid having to have the dollar exposure alongside the bonds.
And is this very much a specific story to US bonds and to US Treasuries, or are there other pockets of value globally when looking to allocate bond within your portfolio?
Well, there's not very much, which is why we're getting interested in US bonds, because that's really where we've seen the pain over the last couple of months in terms of rising yields and falling prices. European bonds, UK bonds and corporate bonds still all look pretty expensive to us. So they might have a role in diversification, as you say, but in terms of a source of return, they really don't look attractive. So whenever building a portfolio, it's really important to not just think about the diversification, but having different sources of return.
Dan, thank you very much.
Thank you.
US President Donald Trump has proposed trade tariffs on aluminium and steel. What do they mean for global stock markets? Nick Watson, multi-asset fund manager for Janus Henderson, is up next to tell us more.
Hi, Nick.
Hi, Emma.
So Trump has proposed some tariffs on commodities, and it's got the world nervous. What has he proposed?
Sure. So for the time being, Donald Trump has proposed tariffs of about 25% on steel imports and 10% on aluminium imports into the United States. So that's sort of in the context of a trade war, which markets now become very concerned about. Markets don't like uncertainty, and given the current volatility in markets are not going to be enthusiastic about anything that might hinder economic growth going forwards.
And it shouldn't be too much of a surprise because it is this kind of protectionist stance which he got elected for. But of course, markets have reacted badly, in particular emerging markets in Asia.
Correct. I think if you look at the markets which have responded most negatively to this, it's been those more cyclical markets, those markets which are more exposed to global economic activity. So you mentioned emerging markets. Germany and Japan have both also struggled amidst this. You are completely correct to say he was elected off the back of this type of policy. And to be honest, we shouldn't really be surprised. A lot of what he's tried to do, whether it's immigration reform, fiscal stimulus or tax reform, he's all managed to get those through. It's also worth observing that he doesn't have to rely on Congress to get this new policy coming through. The final thing I'll say, there is an election coming up in Pittsburgh. I think it's on Tuesday, which the Republican Party are looking potentially like they might lose. And Pittsburgh is a very blue-collar working class base. So it may well be the case that Donald Trump is trying to rile up some enthusiasm amongst his usual electoral support to try to get that election a win for the Republican Party.
And in the short term, as you mentioned, we have seen market volatility across Asia and Germany and Japan. But long term, if he does get these proposals through, what are the markets that will be impacted? Presumably the commodities sectors will be impacted.
Yeah, and I think that's how you could have a read through to UK markets. I mean, as we all know, the FTSE 100, about 70% of revenues come from outside the UK. And you look at some of the large resources companies, let's say your Glencores or your Shells or BPs, they do have a read through to the commodity price rather than necessarily what's happening in the UK economy or the UK market. So that could be the sort of transfer mechanism that has an impact on the UK. On a more global basis, if this trade war rhetoric did really ramp up, and that's not necessarily what we're anticipating, but that's certainly something we need to be cognizant of. Again, those more cyclical markets, Japan, emerging markets themselves, could be more vulnerable. The final point I'll make on that is Donald Trump has been very assertive that China is a trade sort of influence, if you like, and he's trying to make sure that there's not this imbalance between the two countries. In terms of the actual policy that he's announced, China doesn't really get affected here. China does produce relatively cheap steel and relatively cheap aluminium, but that doesn't actually feed through to the US. The biggest of countries who would be affected by these tariffs are more their own allies. So you'd be talking there about Mexico, you'd be talking there about Canada. So those are countries that would be more affected by this rather than maybe the target which his political base is hoping for. And
you did mention the phrase trade war there. Do we anticipate, if this goes through, that there will be a sort of retaliation from some of those markets, which then it could, of course, make more seismic impact globally? Yeah, and that's where the read-through comes through to the global economic backdrop. At the moment, globally, economic growth is pretty broad-based, it's pretty resilient, which is quite constructive for markets. But if you were to see the situation deteriorate, I think the EU's come out and said they might levy tariffs on Levi jeans, for example. China could potentially look at doing something around soybeans. So you can see how that naturally expands out into a wider economic shock. The other point I'd make is that these tariffs are actually quite inflationary. So for the US consumer, that's not necessarily immediately good news because their aluminium production base needs to take some time to get fired up. So it may well have a chilling impact on economic growth while boosting inflation, which is not necessarily a dynamic that market's going to respond particularly favourably to. Because higher inflation means more Fed rate rises. Completely, and it's almost looking back at what was 2017 like. So 2017 we had positive economic growth, muted inflation, and you had supportive central banks in terms of maintaining dovish monetary policy and QE. And through that environment, markets did fantastically well. What have we seen through 2018? Well, the growth's still there, but we've also had inflation come through. So markets are now starting to realise they need to reprice some of these expensive parts of the market. Government bonds have sold off. You've seen some of the bond proxies have a tough time as well. So that policy part of that, the sort of fantastic markets we saw in 2017 is now actually having the opposite effect on markets. So you've got the FTSE all share down 6 or 7% year to date. Yes, growth's good, but you don't have that same accommodative support from either government policy or monetary policy. Nick, thank you very much. You're welcome.
Despite a significant stock market rally, Mighton's David Jane says there are still investment opportunities in the US if you know where to find them.
Hello, David.
Good morning.
So we've had a very interesting start to the year, a return of volatility, which perhaps came as a surprise to many, started by occasions in the US, which many have said this means hang it, get rid of all your US, it's caused all the volatility, but you still have quite a sizable allocation to it, so presumably you're still believing in the fundamentals.
Absolutely. I mean, the return of volatility is very welcome, in fact. Volatility was way too low. The market had got extremely complacent, and particularly the dominance of certain quantitative strategies known as short vol, who were using the options market, which became self-fulfilling. So as these strategies were successful, more money was committed, volatility got lower and lower and lower, and that fed through to valuations in the real market. As inflation returned in people's minds, those strategies stopped working, and you saw a self-fulfilling event which led the market to go down, and now volatility settles at what you might suggest is appropriate levels. So in many ways you need to sit back and say, well, has that in any way changed the fundamentals? Or has there simply been the market sorting itself out? And in my head, the market sorted itself out. Certain people pursuing irrational strategies lost a lot of money. That's a good thing. And the return of volatility is absolutely very good for fundamental-driven managers, because you start to get some dispersion in individual stocks and sectors, which is good for us. So we then look at the overall situation in the States and we can say, well, the economy remains very strong, earnings growth is very strong, bond yields are rising, and that's, again, a good thing. But if you own the assets that benefit from that environment, it looks extremely attractive to us.
Well, I suppose that's the key thing. It's no longer a tide which is raising all boats. It's actually about being a bit more selective about where you're investing within that market.
Absolutely. So if you look at the market year to date, those things known as bond proxies or defensives have been very poor. And even in the correction, which typically you would expect defensive or supposedly low-risk stocks to do better in a correction, they did worse. Because what the market was doing is saying, we need to readjust to a new environment, and that adjustment led to a small fall.
And I suppose the other thing to mention is, as a multi-asset manager, you do have more levers to pull in order to balance some of that risk that you may be taking on in equities. How do you construct a portfolio in that way?
Well, I think you need to look at the market very differently to perhaps what worked in the last 10 years. What worked in the last 10 years, where you had very slow growth, low and falling bond yields, low and falling inflation, was typically companies that could sustain a lot of debt, had stable revenues, weren't cyclical. Now we're looking at a very different economy, aren't we? We're looking at rising interest rates, rising inflation, relatively strong growth. The sort of stocks you need in that environment are very, very different, so you need to transition for that. But at the same time, those kind of stocks, perhaps cyclicals, perhaps more volatile stocks, maybe you can own less equity to balance that overall risk, because clearly the sort of equities you own are more volatile, emerging markets, cyclicals, resources, and so on.
Now, Trump's been out this week talking about tariffs, talking about a protectionist stance. Presumably that protects US assets, but has some negative implications for emerging markets. Is that something you're concerned about, or do you see global opportunities?
Well, we have to look globally around this, and bear in mind that if you're a Chinese steel producer, the US is a very small market to you. Your steel goes domestically, it goes in the region, it goes on the One Belt, One Road projects, so on and so forth. And I think the statistic is something like 3% of China's steel production goes to the US. So we're talking about broadly a globally irrelevant story, particularly when he's going to exempt Canada and Mexico, which are the big producers who sell steel into the US. But what we really should look at this is much less the emergence of global trade wars, which in many ways has been a trend for the last 5 years, actually. We need to bear this in mind. This isn't a Trump story. Worldwide, trade barriers have been going up for some time. What we really need to do is look at this as a grandiose statement for the benefit of Trump's electorate, which actually signifies very little. I mean, it was very helpful for us because we own US steel producers, so in that sense that's good. But in reality, the broader implications are much less than perhaps the market's thinking, because I doubt that Trump is foolish enough to embark on a global trade war, because that's a negative sum game for everyone. Why wouldn't you want to import cheap subsidised, get other people's taxpayers to subsidise your steel imports? That makes sense to me.
David, thank you very much.
It's an absolute pleasure.
Our final guest on this month's podcast is Killick & Co.'s Rachel Winter, who gives investors 3 ways to maximise their ISA allowance and legally reduce their tax bill ahead of the new tax year.
Hi, Rachel.
Morning, Emma.
So we're less than a month to go till the end of the tax year now, which means people really need to get their tax-efficient savings in order. And you've got some top tips for people, haven't you?
I have, yeah. So if you go online and if you type in end of tax year checklist, you'll come up with dozens of things you can and should be doing, such as making sure you've done your ISA allowance for the year, that's £20,000, making sure you've contributed to your pension for that year, that's £40,000 gross, assuming you've earned that much, and also making sure you've used your capital gains allowance for the year, that's £11,300 per person. But what I thought I'd do is talk through 3 ways of just being a little bit smarter with your ISA so that you can save as much tax as possible. So the first one is you can do a type of transaction called a bed and ISA transaction. It's a ridiculous name. All it means is you sell a stock from outside of your ISA and immediately move the proceeds into the ISA and buy the stock back. So you're keeping the stock, but you're moving the account in which it's held. That's good because when you sell the stock, you're crystallising either a loss or a gain. So if when the stock was outside of your ISA, if it had a gain, you could have sold it and used your capital gains allowance. If it had a loss, you could have sold it, kept it by buying it back in the ISA, but you've crystallised that loss. You can tell HMRC about the loss and you can use that loss to offset against any future capital gains in future tax years.
And I think that last point is very interesting because for a lot of people, just because a stock has gone down in value doesn't mean that they want to sell it outright. They might have attractive dividends or they might believe in its long-term growth potential. So here is a way of moving it into a better tax vehicle because it's tax efficient and also getting a bit of uplift on your CGT allowance.
Exactly. So you're keeping the stock, but you're using the allowances outside of the ISA. So definitely worth considering if you do have a portfolio.
And what's the second tip today?
Second one is a new rule that came in this year. So for any money you take out of an ISA in the current tax year, you can put that back in within the same tax year over and above your subscription allowance. So for example, if you take out £100, you can put that back in this tax year over and above your £20,000 contribution. If you take out £100,000, you can put that back in as well as your £20,000 contribution. So very good for people who might have taken money out for a certain cause. That deal might have fallen through. Now they can put the money back in. It's also good for people who have a large investment portfolio with some stocks in an ISA and some outside. And if those people are taking all the dividends from the ISA, at the end of the year, they can add up how much income they've taken and they can transfer that amount from the main account into the ISA over and above their normal £20,000 allowance.
And as you say, this is a new rule for 2017, 2018, because it used to be not that long ago. If you took money out of your ISA, you absolutely lost that allowance, that tax-efficient amount for the year. And presumably it's going to continue into the new tax year on April 6th.
Yes, it will do. So that's the plan so far. You can use it this year, so I'd recommend that you have a look and see if you can use it and just make the most of it. And it is going to carry on into forthcoming tax years as well.
And what's the final tip?
The final tip is that this tax year, you can make £5,000 in dividend income outside of your ISA. Next tax year, that's falling to £2,000. So have a look at what you have in and out of your ISA and see if you're going to be affected by this reduction in the dividend allowance. If you are, then consider whether or not you can have a reshuffle of your investments to try and lower your exposure to dividend tax. And remember that income tax outside of your ISA is much higher than the rate of capital gains tax. So if you're going to have to take some kind of tax on your investments, then perhaps it would be better to have capital gains tax outside of the ISA.
Rachel, thank you very much.
You're welcome.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.